All right, everybody, you're welcome to a continuation of the previous episode, market structure. And today we are actually coming up with context. We're bringing the puzzles together. We're bringing the pieces together to understanding how market structures are being formed. And that is why I have these diagrams here. And if you notice, okay, on the screen, what we have as the market representation is the bullish market. Why is that? The bullish market, whatever we do on bullish market, you can also do in the bearish market. Okay. First things first, what a swing point? A swing point is more like a three candle pattern formation that is having a swing high and a swing low. Okay. That is what a swing point is. Now, a swing point, there are ways we must, okay, there are rules that we must keep to keep them validated. Else, we will just be like every other person in the forex market. Okay, we have rules that validate swing points from other swing points, and those rules are what we're about to learn today. The first rule is this: in a three candle formation, this could be more than one, two, this could be more than four, could go up to five candles. Okay, but usually this three candle should be able to give us what we really want to see. Because if you go into the higher time frame, what you're likely going to be seeing most of the times are just three candles formation, sometimes four, at most five. Okay, so let's just stick with three. So a value swing point is the one that has a swing high and a swing low. In this three candle formation, you can already tell that the middle candle is the one that is highest. The third candle is the one that is a little bit lower than the second candle. Now, the valid pullback doesn't necessarily have to take away or sweep the low of the first candle here. It is not compulsory. What we need to see for us to have a valid pullback before a retreat, before a reversal of the market to its original direction is just the sweep of the previous candle here, which is what we're already seeing right here. Okay. So this is three candles formation, and the rule says the middle candle should be higher than the candles on the left and the candle on the right. And then the third candle must be lower than the candle on the right. That alone will give you a valid pullback. Now, the most of the times that most traders are going to be using is having the third candle sweeping the low of the second candle, and then having the second candle sweeping the high of the first candle, if it makes sense. Okay, that is the only thing that validates a valid pullback. If you look at the second diagram here, you can see that three candles are consecutively moving to the upside direction. So there is no pullback right here. Sometimes you're going to be seeing candles formations like this. Okay, you might see the ARC candles, and then you'll be thinking, oh, this is a pullback, but no, necessarily it is not a pullback. And until the pullback is formed, the market is not true yet. And most of the time, we wait for a valid pullback before we join the market. And why is that? That is because during an uptrend, the recent lows are going to be protected. So once you have a valid pullback, we scale down to a lower time frame and look for a market structure shift, or what we call change of character inside this short term pullbacks. And then would write the trend to the nearest um, uh, higher or high, the nearest low, recent high. Okay. If you look at the third diagram, it would have been a pullback, but if you remember in the candlestick anatomy where we talked about its sidebars, that is what disqualifies this man from being a valid pullback. Why? Because it is an inside bar. So all these candlesticks are considered to be one candle here. So what we want is a candlestick either breaking above this high, which is the high of this, and then breaking below this low. In fact, it is even going to be better if it breaks below it like this, but it's highly unlikely. Okay, it's highly unlikely, and that is the example that we have here. Okay, so this is a valid pullback because it swept the high of the first candle and the low of the first candle. Now, also have it in the back of your mind that the first and second candles are going to be considered to be one because they are an inside bar. Okay, you see the high is above the second candle and the low is below the second candle. But the third candle swept both the highs and both the lows. And this is what we're going to use, okay, to map out the structure of the market here. But before we head to the charts, one more thing. Now you can see that these lows are being protected, all right? And then these are strong lows, strong lows, strong lows. At the same time, long-term lows, long-term lows. Now, I made mention of what long-term lows are in the previous episode, where I said long-term lows are lows that are apparent to the internal swing lows. They take a lot of time to form, a lot of time to break. Now, when the market is trading to an upside, the lows are considered to be strong lows. Why is that? And that is because the lows are expected to be protected. Okay? So when a low is unbreakable or when something is unbreakable, it makes it strong, right? Now, if you look up here, these swing points are what we refer to as weak highs. Okay? Though they are long-term highs and it is difficult to break them, though, but they are the weak highs and why they are the target. Now, with time, you're going to be hearing me saying or mentioning internal liquidity and external liquidity or draw on liquidity. Okay. Now, what liquidity means is if you listen to the introduction of this course, you understand what liquidity is. Liquidity is just money. Basically, without money, the market cannot move. And deliberately, okay, the forex market is designed to always search for money so it can continually run. Because if the market is stiff, money cannot flow. And you know, what will happen afterwards. I'm not going to be the one to say it, All right. So the market must move. And before the market will ride to the upside, it must take an internal or it must take the downward liquidity to enable it to run to the external or to the upside liquidity. In the case of an uptrend, all right, the market, okay, takes away the recent high, takes the liquidity that is resting above this high, and then retraces back to find liquidity that are resting around this low here before pushing to the upside. I hope that makes sense. Now, remember, you can always ask questions in the comment section and I'll be there to answer. Okay. Now, I want us to head on to the price chart because I really want this video to be very, very concise. Very concise. Okay. Now, when you look at this diagram right here, what did you see? This diagram here. This is actually a recent low. Okay. It is a strong low anyway, and it is a long term low, right? LTL. And then this is a long-term high. Okay. Now, when this low was forming, look at what happened. The internal structure. Okay. Look at the internal structure here. We had a push to the downside, a push to the upside, a push to the downside, a push to the upside, a push to the downside. And then you can see that we still try to maintain the direction of the market, but the intention of the market is actually bullish. And at some point in time, there's going to be need to break the market structure. So we had a little pullback, retraced to the downside a little bit, and then we broke above it. Now look at what happened. There wasn't any short-term trend or short-term swings on this leg. We rallied all the way to the up, and then we broke above this weak high here, this long-term high, giving us a break of structure. Okay? That is because the market has been in bullish sentiment from the one. Did you see that? Okay. Let us continue. And then in the process of going higher, we began to experience short-term pullbacks. Now, these are the short-term pullbacks. The whole of this leg, this was the first rest it had. This was the first rest it had. This is going to make sense in a bit, okay? Now, this was the first one. So what you're going to do is mark from here to this place, and then take a low, and then to this high, slow, and then to this high. All these are just one structure. They belong to just this leg. Do not be confused when I said earlier that immediately the market takes a recent high, it is expected to retrace back, okay, to a level, deep level before bouncing back to the upside. Now, it is not a general thing that must happen. After all, it is Forex market. It can always decide what it wishes. Okay, so whatever the market decides, it does. Your best shot is to always make sure that your analyses are intact and then you are not in the wrong side. So, what should you do as a trader in a situation like this? When the market does accelerate this high, you should know that there is a motive behind it. And at some point, it is eventually going to dump so rapidly to the downside, which is what has happened here. Okay? Now, when it got to this level here, it started dumping. More like saying this to this, and then to this, something like this. So in most cases, what you're always going to be, seeing in the market. If it doesn't happen like this, all you just have to do is relax and watch the market unfold itself. Now, during the time of dropping, now let us do something. Remember a strong high, a strong low, and then a retracement, and then a reversal to the downside. Okay. Now, during these levels, look at what happened. Look at what happened. Okay. The market came, it formed this low initially, and then went back to create a liquidity pool right here, where we begin to have some sort of consolidations here. And then here. Okay. For smart money traders, they know within themselves that this place is a liquidity pool. They're going to be waiting, watching this place to be swept before they take action. If they must take action at all, they're always going to be waiting for this place to be swept before they take action. And that is, of course, the best way to trade the forex market. You always have to wait, be patient for the right moves before you take the directions. Okay? So let us start marking the market structure. We're going to start marking the parent structure before we begin to mark the internal structure. So this is the higher high. And then during the retracement, we begin to see lower lows, and then we have lower highs, and then we have a lower low. Okay, enough for now. Now let us look at the market. Let us look at the market. Let us draw the internal structures. Okay. For this leg, there is not much retracement in here. So unless you zoom to the lower time frame, so you'll be able to, see the structures. But what I want us to look at is this. This is exactly a clear representation or clear picture of what I am trying to, try to tell you guys. You can see that right here, we begin to form when we're pushing to the downside. The market started behaving perfectly okay, so that everybody can participate. Now we had a swing low, and then we had a swing high, and then the swing high here will be protected, and then the market will push the downside to create another swing low, and then a short-term pullback to create an internal swing high. Protecting this swing high again, it has to dump to break this weak low, create this. Now look at what is going to happen once the market break below this swing level here. Okay, when the market break below this swing level, it took a deeper retracement to the downside. But although the overall trend of the market is bullish, so what is actually happening here is It just a retracement in the bigger picture, right? Just retracement. And then the market is suddenly preparing to leap higher. So this low is supposed to now be protected, which is what is happening right here. Did you see? So immediately the market broke above this low here. It took a deep dive again, the lower side. Now look at what was happening. Again, it went a little bit higher, came down, went higher. Okay. And then this is not a deep pullback. This is not considered as a reversal, or this is not considered as a correction, a retracement. Okay. Rather, this is just a short term pullback as expected to be taken out. So the market went higher. Okay. And then nearly broke above this recent high. Okay. It took a deep pullback again to this level. And then it broke above this high again. Did you see that? Now, if you look at the internal structures, they are not very much obvious because the market has been so spiky in the past few days. Okay. Because of uncertainty, the wars that has been going on between you know, and I know. Okay. So whenever there's uncertainty in the market, it affects the market the way the market actually moves. Now, what I want you to drive home is until a particular reference structure is broken, the recent lows, the internal swing lows and swing highs are going to be protected. So for the last structure, I'm going to scale all the way into the 15-minute time frame, so that we can see a clear picture of what a true market structure is. All right. Good. All right. Good. Okay, good. So starting from here, okay. So the market started dumping from here, okay. Dump all the way from here. And maybe to use just the marker or the highlighter. The higher high, it formed, and then we have the internal structures that are supposed to be protected like that until the market broke to the lower side. Now, if you look to the probably to the left side, you see that probably there was a structure that the market took before taking a deep retracement. Okay. Now we took a deep retracement, but then the market did what? Broke above this high here. Okay. And immediately the market broke above this high, these lows are then going to be protected. The market went up like that and then formed this low. So this low is going to be protected now until this high is taken off. Okay, immediately this high is taken off, yeah, you can exit the trade and wait for the next structure to be formed. Now, this is a new movement. Like I said, the market was really, really rapid in the past few days. So we had short-term pull, short-term moves. We have a swing high, a swing low, a swing high, a swing low, a swing high. Okay, and then the market retraced back to take after succeeding a particular high here. The market retraced all the way down here, and then this is considered to be a deep pullback. Okay, which I'm not even sure of because I'm expecting the market to have a deeper pullback. There we have it. All right. So from here is where we expect the market to start going to the upside direction from this level here. So we expect the market to start going to the upper direction because it has pulled about 50% below. It is already in its discount zone and we should be apprehending by now. So take this home. During the fall, swing low, swing high, swing low, swing high, protected, swing low, swing high, swing low, swing high, swing low, a swing high, swing low, a breakout structure to the upside, protected low, and then we have a lot of consolidation and the market refused and then it dumped again. We had a swing high here and then a swing low and then to the upside again, and now we're beginning to have protected lows. Did you see that? So this is the most recent swing high before we broke to the upside. So right now, this is where the market is. And as a trader, if you're watching this today, if you're lucky, this is your change of character and you should be expected to probably buy from um is a low. Expect this low to be taken off. Okay, and then this is going to be our inducement zone. Okay, so expect this low to be taken off. And then since we do not have do I have any other block here? This has been retested. This is the only other block we have here, but it is too fragile. So I'm going to be considering this other block. So expect still some cells. This is your other block here. Cool. That's just a bonus tip for you. So that's an internal POI. Okay, good. So what we expect these guys to, break and retest here before we move to the opposite direction. And so that is the end of the section. I hope this section makes sense. I hope you gain a lot from it. And remember, whatever you confuse, please do not hesitate to ask questions. Okay, forex market is easy, it is hard, but yeah, you can scale through. Okay, until we see you the next time, have a wonderful one.